And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is the last day of the month. It's the last day of the quarter, and it's the beginning of earnings season starting tomorrow. It's Liberation Day on Wednesday. I'm already exhausted. The week hadn't even started yet. So just go home this week. We'll come back next week and we'll talk about it. No, lots of stuff going on obviously this week, and of course that's going to, markets remain in turmoil right here because of a lot of uncertainty as what's been going on here lately. We'll talk about Friday's action, what that means for today. But again, we start looking at the kind of the economic data. So it's the economic data is okay, right? So if we take a look at employment, those type of things, real no signs of stress there yet. But consumer confidence has been weakening. We saw the University of Michigan Sentiment Index, its final reading for the month, come out lower than expected. Consumers very concerned about incomes and job security going forward. So again, the impact of all this uncertainty in the markets, particularly when you start talking about the financial markets itself, how it weighs on consumer confidence. And it doesn't really even matter too much if you've got money invested in the markets. It's all over the media. And so people just naturally kind of get concerned about, well, if that's going on, then what does this mean? And people are concerned about their economic situation. Obviously, that's starting to weigh on their views about job security and financial security over the course of the next year or so. So we're seeing that data, drop pretty markedly here. That obviously is a concern for the Federal Reserve. And one of the questions that is going to start getting asked a good bit here, I would expect to start to see this headline coming out here sooner than later, is going to be, when is the Fed going to act? Policy uncertainty, and particularly where we are in this kind of environment. Again, when you go back and look at the Federal Reserve's kind of positioning, they have two main mandates, right? Employment and price stability. So employment's remaining fairly strong, not a big concern there. Inflation's pretty much running in line with kind of where it should be right now. And again, yeah, inflation is a little bit higher than their target of 2%, but it's not above 5%. So again, price stability is pretty much baked into the equation. And so their third kind of unwritten mandate, and this is the one that Ben Bernanke kind of laid out in 2010, is consumer confidence, because consumer confidence is what feeds into the economy. If consumers are confident, they'll go out and spend money. That helps support the economy, supports growth, etc. So one of the questions that are going to start getting asked is, with a decline in consumer confidence, what does that mean for the Fed? Is the Fed going to start changing their policy views because of the weakness in the economic data? So I expect to see that headline, particularly if the markets continue to decline here. I would expect to start seeing more of that question being asked by the media, kind of front running the Fed in terms of when are they going to start making a policy adjustment to adopt for this weakness that we're beginning to see in some of the economic data. And again, some of this economic data, again, you take a look at the Atlanta Fed GDP now, very low reading there. A lot of that has to do with this still, in the month of March, we had a very big pull, a forward pull of products and goods being shipped in to get ahead of tariffs. And again, tariffs, that Liberation Day is on Tuesday. We'll see how the markets react to this. But a couple of things to look forward to here over the course of the month of April is that we are getting into earnings season. So one of the things that's been going on is we've seen a very drastic decline now in earnings expectations for the first quarter, which we'll start announcing next week. That decline in earnings estimates is going to make it a little bit easier, along with the decline in the dollar, will make it easier for some of these companies to post better than expected earnings. So the markets may get a little bit of support here as we get into earnings. And also don't forget is that right now we're in stock buyback blackout period. I'll spit that out this morning. But there's no corporate buybacks going on. Those will restart in the month of April as well. About the third week of April, we'll start getting buybacks in. So why am I telling you all this? Because this kind of leads us up to where I want to talk about the markets right now from last Friday and kind of what to start looking for next, and be careful not to make mistakes here. So this is what you need to know before the bell this morning. So on Friday, the markets had a fairly sharp decline. Now this decline on Friday was, outside of normal kind of parameters of daily pullbacks. However, we had 4 such pullbacks like this in last year. So again, these declines of 1.5%-ish, 1.8%, they're not abnormal, right? They do happen. We had 4 of these last year, and those mostly occurred right before big events. We saw this during the yen carry trade blow up, and then the markets recovered shortly thereafter. We saw that kind of sell-off going into the election. Then the markets recovered after that. So again, big declines like this are an unwinding of positions that typically get at least a short-term bounce following them. So one of the things we want to be looking for here is not kind of jumping to conclusions and making big changes ahead of where you should be making them. So what are we looking for here? Particularly with this morning, futures are pointing down this morning. So we're going to be looking to retest these lows that we set back here in this initial decline. And one of the things that we kind of look for here is look for the markets to hold this initial level of support. Now, if they do that, you should expect a little bit of a bounce here. And look, you're not going to probably get a lot of a bounce, but selling here typically tends to be the mistake for a lot of people, particularly when you've had 3 straight days of declines and fairly large ones at that. And if the market ends lower today, that'll be 4 straight days of decline. Normally, you only get 3-4 days in a row before you get a little bit of a bounce in the markets. And sometimes these bounces can be pretty big. We saw one last Monday that was near 2%. So these bounces can be fairly significant. Now, here's the good news and the bad news. The good news is that markets are oversold here to a degree. So again, we're still running on pretty oversold levels. There's been lots of selling over the course of this decline. And again, we're still within that 10% kind of median annual decline that we often get. So again, the market dynamics so far have not been outsized. The sell-off's been orderly. There hasn't been a lot of panicking going on. But this is the bad news. Bad news is that we failed right at the 200-day moving average. And again, we did this bounce. We had a nice bounce here. Markets ran to the 200-day moving average, failed. That is not a good sign for the markets. And now, if the markets had immediately recovered back above the 200-day moving average, that would have been bullish. This failure and now this retest of lows is not an encouraging sign and does suggest that we could potentially see the markets trade a bit lower here over the next week, 2, 3. So want to be a little bit cautious here about kind of positioning. And if you want to look to add a short position or hedge or reduce equity risk, look for a bit of a bounce here that basically kind of sets the market up for a decline. Now, if we go crashing through this lower level, we could see some more declines immediately. So there may not be a lot of opportunity here to rebalance portfolios at this point. A couple of things to be careful of, though. As I said, markets are oversold here. And sentiment is pretty negative, really, kind of across the board. Hedge funds have been selling pretty dramatically here over the last several weeks. We've had some of the biggest selling on record by hedge funds. Typically, when we see that, we typically get a reflexive rally of some sort after. But whatever rally we get, this is going to be an opportunity to rebalance your portfolio at this point, start looking to remove some risk, raise a little bit of cash here. Again, the markets could immediately reverse and start to move up higher if Trump comes out on Tuesday and says, I've changed my mind on tariffs. This market's going to take off screaming. Right now, it's all about the uncertainty and the economic policy uncertainty in general driving the sell-off. So any changes to that is going to lead to a sharp reversal. But all you have to do is just simply re-put positions back on portfolios. This is, just kind of have to navigate this market right now. But this morning, futures are going to be pointing lower. Market's likely going to open down. We'll kind of see how the market goes there from there, and we'll talk about that tomorrow, kind of what actions to take next. That's what you need to know before the bell this morning. We'll come back, talk about the markets, the economy, a lot of other stuff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So this weekend's newsletter is talking a little bit about the failure at the 200-day moving average. And again, this was, kind of, what we were talking about over the last week is that, kind of that initial challenge of that moving average resistance was key. So, we had that nice rally coming off, that initial sell-off rallied back to that 200-day moving average. Markets failed there. And we picked up on some pressure, some selling pressure. Again, you haven't changed the underlying dynamics much. Again, sentiment remains extremely negative here. Concerns about tariffs, those type of things that are still going on, those haven't resolved themselves. And even though there's been some comments from the White House talking about, there's room for negotiation, there's room for debate, this concern about this coming Tuesday when all these tariffs go into enactment is kind of the big concern for the markets, because again, the unknown is whether or not the companies that are impacted by the tariffs can pass those tariffs on to consumers or not. And again, this is what affects earnings, and markets are trying to reprice for that. The economic data is okay. Again, as we were talking about a second ago, there's nothing really wrong with the economic data yet. Doesn't mean that won't change, and doesn't mean that we won't see a transition of the economy from a slow growth economy to a recessionary one. That is, we wrote an article a couple of weeks ago talking about the recession risk isn't zero. And that's very much the case. We don't see economic data at this point that is pointing towards a recession. We are seeing data that points to a slower economic growth environment, but not a recession yet. And so we'll see what happens, but it's not just here, right? It's also overseas. Overseas, in most of your European countries, they are borderline recession as well, and they've already moved back into policy support. We're starting to see them cut interest rates. Germany, as an example, increasing fiscal policy to help foster, or at least try to foster, some economic growth. We haven't made that reversion back here yet. And so the question is when, as I said a few minutes ago, the big question becomes, when does the Federal Reserve pop their head up and say, hey, we're watching this and we may have to become a little bit more aggressive about our rate cuts based on what's happening with the economic data, et cetera. So again, we'll kind of see how this stuff starts to parse through for the markets. But this is kind of one of the issues. There's an index called the Economic Policy Certainty Index, and this Policy Uncertainty Index, kind of tracks the idea of policy coming out of Washington. And when policy is more certain, markets tend to perform better. And when it's uncertain, that's when markets tend to be having a bit more of a struggle, kind of as we're seeing now. And I think it's important if you pay attention to this chart as an example. We've got a very decent spike in policy uncertainty, and this is all surrounding tariffs right now. If Trump came out today and said, you know what, changed my mind, we're not doing tariffs at all, this reverses immediately. This isn't, policy uncertainty. If you go back and look at the COVID pandemic, right? We had a lot of policy uncertainty around the pandemic because we shut down the economy. Nobody had ever done that before. So knowing, there was a lot of unknowns during the pandemic shutdown because this was an environment we had not been in before. So now this is all about tariffs. So again, a reversal on tariffs of any sort, you're going to start to reduce that policy uncertainty, and that's going to reduce the weight on the markets. But it's also important to note, when you look at this chart, it's very difficult to see the 10% correction that we're in right now because, again, it seems like you're in the midst of this huge market correction, and it's weighing on sentiment, weighs on my sentiment, right? Weighs on my emotions. I certainly don't like down days in markets, right? They're never fun. But it's also, we're still messing around with a 10% decline. Now, could that get worse? Absolutely. And, something we've talked about before, we are typically in a normal corrective cycle. Normal corrective cycles can become bigger corrections. They certainly can. And so we need to be aware of that and be willing to take action. And again, this is why, portfolio diversification, risk management, all those things are coming into play. And at some point, we may need to start aggressively reducing equity exposure, shorting against the box, those type of things. There's not a lot of evidence right now for the need to do that. You're getting there. You're starting to build the weight of evidence for that. So again, and look, if you're trading the markets day to day, right, that's a totally different thing. But when we're talking about longer term investing and growing portfolios over time, we don't want to be taking huge drastic actions one way or the other, but just want to start mitigating and managing risk as needed. This is always kind of part of that process that we talk about. But this economic policy uncertainty is interesting because it is a function of just a singular issue that's weighing on the dynamics of the markets. And so we're going to kind of continue to track this and watch this going forward. But it is interesting now because we're starting to see Goldman Sachs out this morning as a good example, has basically cut their earnings expectations for this year and next year by a decent amount. So again, one of the things that we've been talking about for a while here on the show is that earnings estimates were way too elevated. The markets, obviously market valuations were very elevated as well. So we're starting to see a reversal now. Earnings expectations are starting to come down, not drastically, but they are coming down. And we're starting to see valuations decline. So we are getting some adjustments to the P as well as the E in valuations. And that's starting to get this market a little bit more aligned for where the economy is actually growing and the strength of that growth rate in the overall economy. So, again, this is the big driver. And the one thing that we've got to keep paying attention to is confidence. As I was saying before with the Federal Reserve, their focus is consumer confidence. Obviously, it's stress to banks, right? So if banks come under stress, if banks come under pressure, the Fed's going to act. If you take a wide look at what's happening with consumer confidence is on the decline. As I said, not only is consumer confidence showing weakness in future incomes and future job expectations, There's also concern with the consumer. You have rising delinquency rates, rising auto loan delinquency rates. We're starting to see, rising defaults on mortgages, those type of things. So we're starting to see that stress starting to filter through to the consumer. Consumer makes up 70% of the economy. That has implications for PCE. So PCE is the personal consumption's expenditure. That is 70% of how we calculate the GDP equation. So when somebody talks about the economy and they go, oh, well, this is going on in the economy. 70% of that number is personal consumption. 15%-ish is business investment, imports, exports, the net exports, which is exports minus imports. That makes up a fraction than government spending. So government spending is a big chunk in here as well. So if we're cutting government spending, that's also going to weigh on consumers. But again, the big driver of all this is personal consumption expenditures. The decline in confidence is going to translate into weaker personal consumption. Now, personal consumption expenditures are still running fairly elevated relative to historical norms. We're still up around 3% personal consumption expenditure growth, but that's going to decline. This is the one thing we've been talking about a lot, is that you're going to see a slower growth rate in the economy because of the impact of all these policies on the consumer, not just financially, but also psychologically. And so now we're starting to see this time is starting to evolve in the data. And the question's now going to be is, when do we see it to show up actually in earnings and the earnings growth expectations? So again, as markets come to adapt for this, then markets are going to start to revalue. So the question for investors is, has the recent decline in the markets adjusted valuations enough for a slower earnings growth and economic growth environment? Or do we still have more to go to get that there, right? So to get those to line up. And the answer is nobody knows. The markets will figure that out. But at some point here, you're going to start to see a stabilization between the price of the market and what's happening financially. Now, again, you're getting a lot of short-term tariff volatility. Once we get past Tuesday and everybody knows, okay, here's what the tariffs are, as we've said before, then markets can start to price what those tariffs mean for earnings, right? We just need to get past the point of where, okay, this is what I've got, this is what I'm dealing with, and markets are trying to adjust for that right now. And the question is going to be whether or not they have done enough for it, or if there's still more that needs to be adjusted for price-wise and earnings-wise to get the markets aligned with where valuations should be. Again, this is going to be the big question for the next 2 days, and certainly it's going to be a lot of volatility. Hopefully we get a little bit of support coming out of earnings season. We'll see. But there's a lot of risk to that as well, because I'm sure a lot of CEOs are going to be talking about the impact of tariffs on their business as well going forward. So, all right, come back, talk a little bit. I've got a couple of other interesting topics we'll talk about when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity? Retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
$1 million sounds like a lot of money, and a lot of people don't have $1 million. It's not that much money, considering that most people's net worth isn't $1 million in cash in the bank. That's their house and all their other stuff. That's not liquid. Because if you want to extract the capital from your house, you got to sell it. That's awesome. Where are you going to live?
The Real Investment Show podcast. Same show, your schedule.
I'm going to live in a van down by the river.
At realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, again, there's lots of turmoil in the markets right now. The point that I really want to kind of get across this morning is just not to panic. Look, we're having a correction. Markets are selling off. Yes, we're going through that process. Just this is the time to just kind of refocus on your portfolio, kind of where you're positioned. What are you looking for? And again. This too shall pass, right? You're going to get a rally from this. Now, does the market make new all-time highs? Probably not. Are we in for potentially a bigger corrective process? Possibly. And even during that phase, if you go back to look at, say, 2022 is a good example of this, even during that decline where we were down 25% at one point, peak to trough, and then we finished the year down about 19%. You had decent rallies during that process. And during those rallies, everybody got very, very bullish. And it was like, okay, the correction's over and we're back in this. And it wasn't. Those were kind of those pulls back into the markets where, investors got back long and then kind of a rug pull out from underneath them. And that happened multiple times through 2022. But even during 2008, you saw much of the same thing. And we don't have a financial crisis event going on at this point. We don't have banks failing. We don't have subprime mortgages blowing up. We don't have anything like that right now. This is simply just uncertainty around a singular topic. And whether or not you agree with tariffs is irrelevant. They are what they are. Tariffs are a tax. And somebody's got to pay that tax. And either the company's going to pay the tax and have to absorb it. Now, remember, corporations are the only people that pay tariffs, right? So whether it's a manufacturing product, I'm pulling in commodities of some sort. I'm importing some goods from another country. I'm paying a tariff on those parts, i.e. automobiles. I'll pay tariffs on those parts to manufacture something that I then sell to the consumer. But the consumer does not pay tariffs. The importers, the exporters, the manufacturers, they're the ones that pay tariffs. The tariffs are then passed on to the consumer, maybe. Right now, the consumer's not in a great position to absorb higher tariffs. Concerns over incomes, concerns over futures. Remember, the one thing that economists always forget is consumer choice. And when consumers are stressed financially, which they are right now, we're starting to see that in all the data, right? Take a look at the latest consumer confidence surveys. You take a look at a variety of other data points. They're all starting to show the consumer coming under stress. So if I don't have the money to buy something, I just don't buy it. And if you deliver a product to me that's priced higher because of tariffs, I'll just either A, not buy it, or B, I'll buy something that's cheaper. So consumer choice has a lot of impact on the outcome of tariffs. The bad news for companies is if they're in a position to where they're getting a tariff that they can't pass on, that's going to impact earnings. So again, that's what we're going to start finding out more over the course of just the next 2 weeks. We're going to start having the banks report, not this coming week, but the next week. All the major banks will start to report. Then we'll start hearing from the regional banks. We'll hear then by week 3, we'll start getting into Apple, Microsoft, Google, et cetera, the big boys. So we'll start hearing real-time information about the impact of tariffs on their business, or at least the threat of it. And the question is whether or not they can maintain those profit margins. So we start getting forecast for earnings estimates, for margins, those type of things. We think our forward estimates are going to be X. Are those going to be in line with expectations, or are those going to be marked down? If they're marked down a lot, this market's got a lot more to go. Remember, the one thing about this, the market decline has absolutely nothing to do with tariffs on the surface. Market advances, market declines, it doesn't matter. At the end of the day, the only thing that drives the changes to the markets are the expected rate of change to earnings. So, tariffs are just the impact, right? That's the catalyst that moves the earnings needle one way or the other. Could be anything. It could be economic data. It could be hurricanes. It could be whatever it is. While we look at that event, and again, we've talked about rationalization before, we need to rationalize why the market's doing something. Right now, what the markets are doing is repricing for lower earnings. The question you have to ask yourself as an investor is, have earnings been adjusted enough to compensate for the current valuation or the current price of the market, as we were talking about a minute ago? But earnings is all that matters. And we're going to start getting a lot of that data here over the next couple of weeks. So again, this is the challenge that we're in. And it's also just important to remember that we just came off all-time highs, right? So we're having a correction. And again, as I showed you the chart earlier, you can barely, if you look at the chart right now of the S&P going back over the last 20, 30 years, you can't even see this decline at the moment. But it feels terrible. I'm not taking that away from anybody, right? The decline feels terrible. The market's down 6% for the year so far. Be down a little bit more today. We'll be down to about 7% this year after today. But again, it feels terrible. But we also have to keep things in perspective. So when we go back and look at our portfolio, yeah, there's been some damage. A tornado just went through the middle of the trailer park. So there's some damage. We just have to figure out how to repair it now. Make some adjustments, make small changes, start adjusting for allocations, risk, those type of things. And again, don't make big, massive changes all at one time. The worst thing you can do as an investor is make big dramatic changes based on emotional dynamics that are happening in the markets. And we see that all the time. And again, we're in one of those environments right now, lots of pressure on emotions and on sentiment right now because of what's happening in the markets. You may like Trump, you may not like Trump, and it doesn't matter, right? Because, again, markets are politically agnostic. They just respond to the changes that are happening in the markets. Tariffs are not, the next black swan event. Black swan events are issues that are credit related in general. Think about the financial crisis, .com crisis. That was credit. That was a credit related event. We look at the .com crisis and we say it was just the failure of all these .coms that was the problem. No, that was in effect a credit related crisis because there was a lot of companies, a lot of banks that had loaned money to companies like Enron that turned out to be a complete fraud. WorldCom. So there was credit risk in that event. So when you start talking about black swan events, those are generally credit related, not tariffs are not a credit event. They can also be repealed tomorrow. So if things really start to get bad, Trump can just say, hey, I'm taking the tariffs off, right? I don't think he will, but he could. So those aren't credit-related events. So it's not. So the Trump administration is not the black swan event that everybody's looking for. No, we're just repricing for the impact of a tax on earnings. And we just need to keep that in mind as we start going through this process. And again, it's going to be tough. It's going to be tough for a few days, a few weeks. This will end, right? And then in a few months, we're going to look back and go, yeah, that was a really tough period. Just like we did last year in August, don't forget, we were down about 8.5%, 9% during the yen carry trade blow up. Year before that, the summer before that, we were down 10% peak to trough during the summer over growth concerns, earnings concerns, AI concerns back then. It's a terrible 3 months. Everybody was very upset, right? Everybody was despondent because the market was just grinding down for 3 months in a row. And then by the end of the year, everybody's like, all-time highs. This too shall pass. Got to stay focused is the important part. Don't let your emotions outweigh your process for managing your portfolio. This is why, having some bonds in your portfolio, yeah, I know. They've sucked for a while. They've been performing great as of late. Helping hedge that risk helps you get through this period of volatility so that it can allow you to make some adjustments. And most importantly, don't forget the most important lesson of all this. Market declines provide opportunities. We're always running around talking about, it's always interesting that people are talking about, oh, this is so overvalued, so overpriced, blah, blah, blah. Market corrections give you opportunities to buy things at a discount. So don't forget, while you're in the process of trying to figure out what you're doing in your portfolio, don't forget to also look for the opportunities to buy strongly growing companies at a discount. It's the old Chinese proverb, crisis equates to opportunities. All right. Quick break. We're going to come back. We're going to talk about parents supporting their kids. Interesting article out. There's a study out today. We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as you may or may not know, I am a parent of divorce. I'm not sure how to actually phrase that. I'm divorced. I've been married for a long time to my lovely princess, and have 4 wonderful kids with her, 2 of mine and 2 of hers, and we got together when our kids were extremely young. My daughter was 1, and my son was 3, and her daughter was 3, and her son was 6. So very young kids. They all grew up together. They're all kind of brothers and sisters now. My oldest lives overseas. He's doing fantastic. Lives in the UK. He's learning that the UK sucks. Huge Trump supporter. But all my kids, when they turned 18, they were all required to get jobs and become responsible. And this has been kind of an interesting time. And my youngest daughter, she's 18. She's about to graduate high school next month, which I am totally enthralled with. She's got a scholarship to go to Baylor. She's going to be studying to become an anesthesiologist. She's got her track together, so she's doing great. But most importantly, it's my last child support payment. So I get a pay raise June the 1st, as soon as she graduates. So looking forward to that. But it was interesting because, again, I get a lot of grief from you guys in the chat as well as I get emails from people because I talk about, look, I don't pay for my kids' college. They pay for their own cars. They pay for their own insurance, those type of things. I provide a little help. Their phone bills are on our family plan, that type of thing, so they don't have to pay that yet. But for the most part, I try to make them as independent as possible. I want them to be self-sufficient. I want them to understand the value of money. I want them to understand paying bills. Having to take your car in to get it inspected, which my son found out the hard way. So it's just trying to teach those life lessons. So because I want them to understand several things. I want them to understand that A, life is hard. And B, you have options. And while our kids may not always do the things that we want them to do, like my oldest, who decided to, pack up at 18, move overseas. I was like, this is never going to work out well. He's done great, right? Prove me wrong. I'm very proud of him. He's done fantastic. He's got a good job. He tried to skirt going to school, but that didn't happen. Could have gone to college a lot faster, got a degree. Tried to tell you. He listens to the show, by the way. Tried to tell you, but he's done great. He's done fantastic and self-sufficient, doing wonderfully. Couldn't be prouder of him. But it was interesting because there was a study out this morning, and this is the thing that I've been trying to stress. I talk to this with, to people a lot who are doing this because they're hurting themselves financially over this presumed obligation to be the support line for their kids. More than 50% of parents with a child over the age of 18 are providing them with at least some financial support, according to a recent report by Savings.com. Half of parents with adult children provide regular financial assistance to their grown offspring. The average support per adult child is $1,400 a month. That's about 6% higher than last year. 83% of supporting parents contribute to their adult kids' monthly groceries, 65% help with cell phone bills, and nearly half, 46%, pay for vacations. More than 3/4, 77% of supportive parents attach conditions to their financial assistance. 23% give money without any conditions. Nearly 50% of parents have sacrificed their financial security to help their grown kids financially, and most supporting parents feel obligated to help their kids with money. That last line is the most important part. Look, I don't care if you help your kids, as long as you can financially afford it, right? And this is the thing that we try to talk with parents all the time, because we see this a lot as advisors as well. Parents come in, their kids are 23, 24, 25, still living at home. And there's lots of excuses. Well, as soon as they move out of the house and get a job, and then they'll be on their own. But you're actually hurting them in that process. And this is the thing I try to get across to my kids as well, is that if I let you come back home and live with me, that's not good for you, because now your entire search radius for your career gets defined to the area that you're living in, right? Well, I've got to live with dad and mom, so my job's got to be somewhere close by. So I've now limited my ability to go get a job, because I've now defined myself to a very small area in terms of the national search or global search for a job. And also, if I'm helping you financially, I'm not encouraging you to move forward, right? I'm hindering you. You've got to learn that, hey, you know what? You can't live in a $2,000 a month apartment to start out with. You can't graduate college and buy a house. Right? That's just not the way it works. It's never worked that way. And one of the arguments I get most often is like, well, this isn't like when you grew up. Well, it is in a lot of ways. Yeah, houses cost more, for sure. My first job out of college paid $12,000 a year, right? I was banking at that point. Salaries were a lot lower back when I graduated college, back in my day, right? Average incomes were dramatically lower than they are today. Yes, the cost of houses were cheaper because incomes were lower. And also, too, houses were very small. The average house was 1,100, 1,200 square feet, 3-bedroom, 1.5 bath, single story, yard, that type of thing. It wasn't these 2-story McMansions that people are trying to buy. So part of this is just the reality of going back to understanding what the value of money is. And the one thing that we've done as parents is taken away that ownership of responsibility. Getting started in life is tough. It's never easy. And again, I don't have any problem with you helping kids financially. That's totally up to you how you do it. And look, if my kids get in trouble, I'm certainly going to help them, right? To a degree. Now, if they run themselves up into a bunch of credit card debt ain't paying off the credit cards. So you can just go run up credit cards again. That's not going to happen, right? That's on you. But if something happens and you're in trouble, I'm going to help you out. That's my job as a parent. But what I can't do is displace the financial security for my wife and I, and who are dependent upon what I'm doing for our retirement, give that to our kids, because here's the problem by doing that. Again, when we go back and look at the study, you have over 50% of people now sacrificing their financial security to help their kids. Think about that for a moment. If you're doing that, you're sacrificing your financial security today to help your kids. Who do you think gets that burden in the future? Right? So just as your kids are finally up on their feet and getting out, you've got to go to them and say, hey, I can't work anymore. I'm in the hospital. Whatever's happened, I need you to support me. Now, what have you done to their financial future? So this is the point I'm always trying to get across, which is that we have to cut those ties at an early age to make them financially independent so that we can secure our future, so we don't become a burden upon our children in the future, right? We see a lot of this today with what we call these sandwich generation families, which are a young set of adults with kids supporting their parents. So this set of adults is now trapped between supporting their children and supporting their parents. They're sandwiched in the middle. And this is becoming a much bigger problem. This is why you're starting to see more multi-generational families all living in the same residence, because they're all having to support each other. And now there's lots of reasons for that. Most of the reasons, when you really get down to it, is years of poor financial choices. Not saving enough, not investing enough, not managing a budget, living beyond your means. I mean, there's very rarely do you see a situation occur that wasn't to at least some degree self-induced because of bad financial choices. And this happens, right? How much money do parents give their adult children each month? All parents of children over the age of 18, over $1,400 a month. Parents of Gen Zs, which are the ages of 18 to 28, is almost $1,800 a month. Parents of millennials, right? This is a younger group. Almost $1,000 a month. Quick math for you. Go take $1,000 a month. Run it out over 30 years, because you're probably got 30 years before you die in most cases. Compound that at about 6% a year from the markets. See how much that $1,000 a month is actually costing you. That's your financial security. Anyway, interesting study about that today. It was published out by savings.com. Go look it up if you want to read the rest of it. Get by the website, realinvestmentadvice.com. We'll be back here tomorrow with John Penn, update you on where the markets wind up here and what actions to take next. Look, just be patient. We'll get through this together, and we'll see you back here tomorrow.